Okay, welcome to our next panel. We've got a tight schedule today, so we're going to start. My name's Anil Kashyap. I'm a professor at the University of Chicago. I've got the pleasure of moderating. I want to thank Vice Chair Bowman for putting together such an excellent panel and a fantastic program overall, so thanks for including me. I'm joined by four people with different backgrounds and perspectives for this very non-controversial topic about the GSIB buffer. So we're going to start, I'll just go down the line here. So Steve Chubak is a managing director at Wolf Research, one of their, leads their bank analyst team. You're going to see some of his numbers later on. You'll see why it makes a good deal of sense to have him here. Wilson Irvin, it says former chief risk officer at Credit Suisse. He wants me to remind you that that was some time ago. You might know him as the guy that I think of as inventing COCOs, really. I mean, that came by a push from the industry, and Wilson was central to all of that. He was recently at the Treasury as well, but now he's just a private citizen, so he can say anything. Al Moffett is the global treasurer at JP Morgan Chase. He's been there for 18 years and has seen many parts of the business. And then finally, Andrew Ullman is the managing partner of the DC office of Mayor Brown. But he also has worked as a Senate staffer and was in the White House at the National Economic Council. So we've got a diverse set of people here. And so without further ado, Andrew, you're up.
Thank you. Well, first of all, I want to thank the Federal Reserve and Vice Chair Bowman for organizing this conference. I really do think that such forums such as this are critical for building consensus around important policy reforms so that they're durable and that they're well thought out. So thank you for having us today. I think it's especially important on the topic today of capital regulation, because capital requirements are the cornerstone of financial regulation, and that's critical that they're properly calibrated. So I think it's kind of appropriate that we start this discussion on the GSIB surcharge, but I think this discussion also is relevant for our larger conversation today on capital requirements, to start with understanding the statutory framework, because as much as what happens in Basel is important, what Congress does is the most important, and it sets the parameters on what policy makers can do and what they should be doing. And so to start is the key statute here governing the GSIB surcharge is Section 165 of the Dodd-Frank Act, which was mentioned earlier today. And that section requires the Fed to impose more stringent prudential requirements on bank holding companies with assets above $250 billion or more, including more stringent capital requirements. Now, Section 165 was adopted as part of Congress's effort to increase capital requirements for the largest institutions, but generally throughout the financial system in the wake of the global financial crisis. Now, what's important to note about Section 165 is that it functions to build off of the Gramm-Leach-Bliley regulatory framework that was adopted in the late 1999. Gramm-Leach-Bliley, you may remember, was the statute that allowed banks to affiliate and have with securities firms, insurance firms, and allowed holding companies to have material non-bank subsidiaries. That model is allowed for the creation of much larger financial institutions that could offer a broader range of financial services. Now, at the time Congress was debating Dodd-Frank, it did consider several proposals that would have undone the Gramm-Leach-Bliley framework, including reinstating Glass-Steagall or imposing limits on the size of bank holding companies, but it did not adopt any such reforms. Instead, what it did is through 165, it required the most complex bank holding companies, the ones most likely to have significant non-bank subsidiaries, to hold more capital at the holding company level. Implicit in this policy decision was that by requiring more capital at the holding company level, such institutions would be in a better position to address any issues with bank or non-bank subsidiaries. So this already reflects on our kind of the earlier panel talking about the leverage ratio and why having more flexibility for capital at the holding company level is a useful thing. Well, it's not only a useful thing, it's also what Congress contemplated in the statute. Now, Congress granted the Fed pretty broad discretion on how to implement these heightened prudential standards, including capital requirements. but it did impose some really important conditions. The first is it required that the enhanced prudential standards, including capital, be tailored. And tailoring's got been a kind of a buzzword that's been going around this town for a long time, but it is in the statute because Congress did want to avoid creating one-size-fits-all regulation with heightened prudential requirements, including capital. And the reason for this, one of the key reasons, was that it did not want to have these heightened capital requirements impact banks' operations of other key services, including like capital markets activity, custody services. So there was recognized that there was a cost that came with heightened prudential regulation. Second is that under 165, capital standards are to increase in stringency gradually and is appropriate in relation to the company's size, leverage, and other measures of risk. In other words, there is supposed to be a smooth application of prudential standards and capital, somewhat similar to what we have under the GSIB surcharge now. However, Congress also specified that it didn't want to have small changes in risk that would result in sharp, discontinuous changes in prudential standards. In other words, it wanted to address and minimize cliff effects that could come from having too big of buckets on the application of capital standards. Now, there's a second reason Congress also wanted to have this gradual application, and it is a little bit of the skunk at the GSIB surcharge garden party, which is, and I'm going to quote the language from the Senate Banking Committee's report on the bill that became Dodd-Frank, is that they wanted to have gradual application, quote, to avoid identification of any bank holding company as systemically significant. So current model may be a little off on that one, and certainly the late Justice Scalia would have said, well, that's only legislative history, and it shouldn't matter. He has a little point in that. On the other hand, it is very clear that Congress did not want to have any enhanced prudential regulations to clearly signify that any institution was too big to fail. Now, the third restraint and requirement that Congress put in 165 was that these capital requirements were supposed to be part of a broader range of heightened prudential standards, some which have already been mentioned today: resolution plans, stress tests, leverage, liquidity requirements, and that they were all to work together. In other words, the GSIB surcharge was not supposed to be a big tax or a standalone capital charge that did not reflect all of the other heightened prudential requirements on institutions, bank holding companies above 250. It should all work together. So I think going forward with that framework, what it means is that there's a fair amount of flexibility, but there are some important constraints that Congress wanted the Fed to think about when it imposed these heightened prudential standards.
Okay, thanks. So before we go further, I want to I'm figuring most of you don't spend your time studying method 1 versus method 2 to calculate the GSIB surcharge. So before we get into the further details, I'm going to just give you a little bit of background. There are two ways, two alternative formulas. There's the one that was agreed in Basel, which we're going to call today method 1, which tries to figure out the basic point here is the more interconnected you are, the higher was to be your capital standard. And there's a Basel agreement that has 5 indicators that I've listed there: complexity, size, interconnectedness, substitutability, and cross-jurisdictional activity. And you're compared based on a set of global peers each year. The Fed, 10 years ago, went in a slightly different direction for reasons that we can revisit, but there are 2 things that I think you should realize now. One is that it doesn't have exactly the same 5 indicators. It's instead probably burned by the GFC where there were all these runs. Reliance on short-term funding is in there. There's no cap on any of these things in method 2, which is what's being used now. In method 1, the substitutability factor is capped. And then perhaps most importantly, I think Steve will talk about this when he gets there, is these 2 methods have diverged. If you just look over time, the Fed's method takes data from essentially 2012 and 2013 and benchmarks against that. And so as this banking sector has become bigger, the method 2 charges have risen. So if you look over time, this is one of these beautiful charts from this report that Stephen just put out. shows in the top method 1 and in the bottom method 2, and this is as of 2016 versus now. These things all come into effect with a lag, but you can see that there's a time trend. All the gray bars in the bottom picture are higher than the blue bars, which means over time there's been an increment, and this feeds to what Andrew was just talking about, whereas in method 1 it's been more or less flat. So when we come to these things, I hadn't seen this till I read his report. I did not realize how big the drift was that was coming from all of this. Okay, so now let's go back to regular programming. We're gonna, the theme for the rest of the run of the show is each of the rest of the 3 of them will each give 5 minutes on whatever they think you absolutely have to know. Then we'll talk specifically about method 1 versus method 2 versus some other method if you want to make a recommendation. And then lastly, in a third go, any other technical fix-ups that you think are important that could be interacting with the earlier 2 panels, or just some technical fixes so that it's on the record and it's been recorded, and then we'll go to the audience. All right, so Wilson, the floor is yours.
Great, thanks, Anil. In line with the last panel, which gave us a little bit of history, because I'm of a certain age, I'm going to indulge in some history as well. What's the goal of this GSIB surcharge? How did we get here? Pre-GFC, there was no GSIB surcharge or large bank surcharge. The world was flat for capital. I guess our computers were simpler then, so we just did a simple ratio. So the more conceptual question for this panel is, why do we have this extra charge for GSIBs for large banks, and how should it work? There are actually 2 origin stories for how we got here today. One argument for GSIB was set out in a 2015 Fed paper that big banks need to have higher capital and therefore lower risk of failure because they do more damage in failure. Treasury Secretary Besson talked about a hazmat truck on the highway. That's clearly going to create more damage than a little Mazda Miata that skidded off on the side. So since the impact is bigger, we're going to want the big trucks to drive safer, and the Fed paper basically does a lot of math to equalize the expected amount of damage between a small bank failure and a big bank failure. Today, that surcharge requires about $230 billion of extra capital for the 8 U.S. lucky GSIBs, or about 3% in CET1 ratio terms. It's about a quarter of the total GSIB capital requirement here in the U.S. It's chunky, it's important, but it's only a part of a more complicated and evolving CET1 story, so we'll get into more of that a little later. There's also a second argument for GSIB surcharge, which is really separate logic. Back in about 2010, there was a senior regulator meeting over in Europe where a bunch of us big banks were told there was a temporary GSIB surcharge coming because we didn't have a too big to fail solution yet, we didn't have it funded, and until we got that, we're going to need some surcharge to reduce the risk of getting to that promised land. So the rationale for this one was centered on the too big to fail problem, which was still very confused at that time. These 2 frameworks never really got reconciled. The GSIB capital uplift to equity did not include any benefit for when we figured out a smoother resolution path, and vice versa. So over the last dozen years, we've actually added our own form of GSIB capital in something called TLAC. Being a GSIB means you need to issue TLAC to fund your own resolution, which is a huge change compared to the drama of 2008. I was unlucky enough to sit next to Tim Geithner on Lehman weekend, and he was frankly in a lousy place. He had a $600 billion problem, and he didn't have any ammo to deal with that. His least bad option was to invite a whole bunch of banks, probably about this number of people, down to the New York Fed for some kind of lousy sandwiches and stuff, and spend the whole weekend trying to borrow capital from those banks to fund a bad bank and then get an M&A takeout for the good bank. That didn't work. It had a lot of dance steps, and it's lousy to be in that kind of situation, to have a big bank failure on your hands, but no ammo to work with. But the resolutions that we've been designing over the last decade don't require a consortium, don't require a weekend, don't require an M&A takeout, but instead tries to self-fund resolution via TLAC debt. And TLAC today isn't a small number. It's 1.1 trillion in the United States. That's 4 times bigger than all the TARP funding that went to the big banks and got them back on their feet. And to me, this is actually the most important sleeve of GSIB capital. And that should help us mitigate to some extent some of the upward drift that you saw in that previous slide from Anil. I'd like to mention 2 other points for the big picture section. First, the real answer for GSIB equity capital buffer doesn't turn on a single component. We have a lot of components that build up into this thing. Investors and creditors care about the whole capital stack, and we have a lot of reforms in place, and figuring out exactly where that dial gets set is going to be where the rubber meets the road. If we turn all of them to the left or the right, I don't think we're going to have a very good meal. I think we'll over or undercook it. So getting that balance right and getting to a decent total number, I think, is the critical part. In the 2023 regional bank crisis, it was really, really helpful that the US GSIBs were perceived as rock solid. That crisis kind of faded from memory pretty quickly. You don't hear people talking about it very much now. And it was a much different episode than we had when the system went from small banks to medium-sized banks and to large banks in 2008. So while I think that we can do some tailoring around how steep the GSIB surcharges get, I do think that we want to be careful not to experiment with that achievement too much, because we've achieved a lot in the US by making the core of our system so much safer. 2023 raises one more point. The regional bank crisis exposed a soft spot in the middle of the US bank landscape. First Republic and SVB were $200 billion banks that fell apart quickly and cost the FDIC and then a bunch of other banks in this room a lot of money as they got charged back for those payments, and caused a lot of stress around the system. SVB even required a systemic risk exemption, which is quite an accomplishment for a bank that is so far away from being a GSIB. There are 8 or 9 non-GSIBs that are bigger than SVB today that don't have to carry either of the GSIB capital protections. Several of these are in the $500 billion range, which is coincidentally about the same size as Lehman or about the same size as Continental Illinois, the OG, too big to fail bank, if you scale it up for the size of the banking sector back then. These super regionals are clearly better run because they survived both the GFC in 2023, but unfortunately good management is not a permanent immutable attribute. So I'd argue that we have a too middle to fail issue that remains still unaddressed today, and I hope we don't have to wait for a second 2023 to learn that lesson. I wouldn't want to be stuck in Tim Geithner's rough weekend of dealing with a very large non-GSIB failure without any extra capital. So if I was going to sum all that up, I think GSIB surcharges, some of this buffer, should start a little bit earlier in the system, but we can also flatten out how it affects some of the very largest banks, and I think that would give us a good balance of the overall result. Thank you.
Al, you're next.
Great. Well, thank you. So yeah, this is a topic that's well in the weeds and well into footnotes, so we'll deal with all that part later. So I think I'm going to uptick Wilson's comment about 230. So flipping over at 4Q24, the 230 had ticked up to $250 billion. So yeah, it's a big number of capital, and really the question is this the right number, and how do we arrive at that? Is that the right distribution? Just in terms of the sort of GSIB points measurement, so which is roughly linearly aligned to the surcharge itself. So since the first year in 4Q15, that's up about 22%. Just for some comparatives, if I flip over to GDP, real GDP since then is up 24%, and so nominal GDP is up 62. So pick your measure, but certainly the system has grown, and the largest banks have been required to hold a bit more. And before we get much further into this, I think it's really important to say that really what we're talking about is high versus very high levels of capital, and not low versus high. And I think it's an important effect. So I think that and just this week is a pretty unique one, because this past Sunday was actually the 10-year anniversary of that Fed Method 2 white paper. So I encourage you to go ahead and read it. Not by me. But I think, and sort of since that framework was adopted, just remind everybody that all banks grew and not just the GSIBs, right? The surcharges are only applicable to the GSIBs, but all banks grew. The US GSIBs grew since then, or really for a comparative basis, just in 4Q17, the 8 GSIBs are up about 19% in score points. Admittedly, JP Morgan's up 39. The Cat 3 banks, when you think about what is the GSIB surcharge, that sort of differentiates the required capital at GSIBs versus the non-GSIBs. But the Cat 3 banks are up, meaningfully and kind of closer and well north of the GSIB overall size. So the incentives set forth in regulation do work. So I'm going to come back to this throughout the session, but I just want to make those couple of points for sort of two big reasons. So one is that the GSIB itself is a relative measure that drives additional capital between GSIBs and non-GSIBs. And two is that all banks have grown significantly in this measure. And that means the Fed should do a fundamental relook at the calibration rather than a simple rinse and repeat of the 2015 calibration. So let me just go to my first, my direct sort of main 3 points here. So one, fixes are needed. We must start with the policy goals and then perform the macro calibration and go from there. So the 2023 NPR and all of the subsequent Fed speeches just simply don't go far enough to address the issue. The policy goals, when we talk about what policy things we're trying to address here, so that should really include the appropriate trade-offs between economic growth and safety and soundness, both important and needs a proper balancing. Importantly, think about designing the shapes and contours of the activities that are contained within the banking perimeter. In having a step back and looking at how do we reduce the risk of bank runs and promoting financial stability. So all these are critical, and it's important for the public to understand how this banking, this complex banking regulation is really meant to protect the system, because the whole is greater than the sum of the parts. The second big point is that diversification should be valued and not penalized. And so having diverse business model and diverse set of income streams is a source of strength for all companies, whether financials or otherwise. The third is that the GSIB surcharge is really the final and additive factor in the capital stack. And so the calibration must, and I say must, reflect the totality of all regulations to ensure it's fit for purpose. If we look at everything and make sure the cost of low-risk activities are appropriately calibrated. So as we think about the current GSIB framework, and we should keep an open mind, there are two important lenses to apply. Is that the U.S. GSIB method 2 does provides a gold-plated differential versus the non-U.S. GSIBs. And domestically, the GSIB surcharge is a capital differential between the CAT 1s and the CAT 2, 3s, and 4s, or the non-GSIBs. For the avoidance of doubt, we support tailoring. Tailoring is important. We recognize it's reasonable for the largest banks to be held to a higher standard. It goes back to my point earlier, right? This is high versus very high, and not should we have it at all, or is it high? But the challenge is really in defining that higher standard. So the U.S. GSIBs are already subject to the highest standards of resolution planning, recovery planning, TLAC, long-term debt, as well as the most stringent liquidity risk management practices and the highest levels of capital. The capital dimension is particularly key here, since the GSIBs are also subject to an even higher SCB through the global market shock and largest counterparty defaults. So later on, we'll nerd out on the method 1 versus method 2. In short, and speaking as a practitioner, the Fed did some smart things with the method 2 that helps us better manage the risks when compared to the shortcomings of the method 1 paradigm at Basel. One important issue identified by the Fed was the clear recognition of the structural headwind due to economic growth, the infamous footnote 25. Unfortunately, this has been left unaddressed, although a temporary solution was proposed in the final rules. But all this taken together, it takes us back to my first key point, is that the Fed needs to address the broader policy goal, and we could redesign and recalibrate the GSIB surcharge accordingly. This is critical to ultimately arriving at the right capital differentials that should exist between the GSIBs and the non-GSIBs here in the U.S., as well as the differentials between the U.S. and foreign GSIBs.
Well, first, Fed Vice Chair Bowman, members of the Fed, it's an honor to speak before all of you. Thank you for the opportunity to participate in the panel. Maybe just to set the stage, I do think we need to be clear about what we're trying to accomplish with the review of the GSIB framework. And from my perspective, the goal is really to address the shortcomings with the current GSIB framework, ensure that the largest banks can remain competitive on a global scale without compromising the safety and soundness of the overall system. So it begs the question, why hasn't the Method 2 framework worked as intended? What are some of the shortcomings that need to be remedied? So I'm going to list 5 here, and I'm sure others will have different ones that come up on their top 5 list. But first is GSIB surcharge and capital volatility. When Method 2 was first proposed, the intent was to avoid the pitfalls of Method 1, including volatility in global denominators. But as we showed in the chart earlier, history has proven that the GSIB surcharges have been more volatile under Method 2 and have also seen much greater inflation, which, as Aldous mentioned, is really more attributable to economic growth versus increases in systemic risk posed by the large banks. The second point is just that Method 2 is not an accurate gauge of GSIB riskiness based on some measures. Going back to 2016, when comparing GSIB score growth versus risk-weighted asset growth, GSIB scores have inflated 3 times faster than RWA. The third point boils down to US bank competitiveness. Gold plating, imposing tougher capital standards, it does create an uneven playing field. It might be the proximity to Al here. I feel like I have Jamie Dimon in my ear saying we shouldn't get complacent. We have the deepest capital markets here in the United States. It's important to protect that advantage. Fourth point is about unintended consequences. Imposing higher capital requirements, it causes a pullback in lending, it limits credit availability, but especially to low-end consumers. It also drives much more activity outside the regulated perimeter. And the fifth and final is codification. Al just alluded to this, but the intent of Method 2 was to revisit the fixed coefficients with some regularity, and I believe the exact terminology was periodically revisit. It's been 10 years, and it's been revisited 0 times. There remains no established cadence for updating coefficients, which ultimately inform the Method 2 calculations, and this is certainly something that needs to be remedied. So what alternatives would we propose? If the Fed's goal is to be more in line with international standards, ensure the largest banks are not permanently disadvantaged relative to the global peer group, then simply move to Method 1. To borrow from Mike Mayo's earlier presentation, it's simple and strong. If the goal is to maintain some form of gold plating and continue with some version of Method 2, then it does need to be significantly overhauled. The first point is coefficients. We need an established cadence for updating coefficients, and the process for updating it really needs to be codified. It'll also help address a much-needed fix to adjust for growth in the financial system. The second point is short-term wholesale funding. This is a key pillar of Method 2. It's grown much larger than originally intended. This should be reset to 20%. Some sort of cap should be put into place. The third point is updating GSIB buckets for new probability of default versus loss given default measures. And borrowing from Al's earlier remarks, this is certainly where one can really geek out. But the largest banks are inherently less risky today than they were 10 years ago when the Method 2 proposal was first introduced. That should be contemplated when revising some of these GSIB bands. And it also dovetails nicely with this whole notion of conducting a broader, more holistic review. So in closing, it's not clear why the US needs to continue to gold plate. I would argue the adoption of Method 1 represents a much more elegant solution. It addresses the shortcomings under the framework, and it also is simple and strong. There are real consequences also to gold plating, which have a greater impact on low-end consumers in particular, and also risk driving more activities outside the regulated perimeter. It's also worth mentioning, and I haven't heard this yet, but the solution is not always increasing capital requirements, and I cannot stress this enough. Higher capital in isolation, it's not a cure-all, it's not a panacea, as evidenced by the recent failures of Silicon Valley and Credit Suisse, both of whom had capital ratios well in excess of regulatory minimums. And in the case of Silicon Valley, was largely due to funding versus capital pressures. So lastly, if the decision is to continue to gold plate and maintain some version of Method 2, at a minimum, we need to significantly overhaul the calculation simply to ensure that it's working as originally intended. So with that, Neil, I'll pass it back to you.
Okay. So just to bang on about this to make sure everybody understands what's coming next in terms of the math. So when he's talking about fixed coefficients, there's these 5 factors, and you have to multiply the factors times some number to convert it into what's required. Those numbers under Method 2 have been fixed, okay? One of the inputs is the reliance on wholesale funding, and that number has grown, so it's got taken on more weight. And then the third consideration is that the benchmark is what share do you have relative to a fixed set from 12 years ago. Part of the reason for Method 2 was this concern that if you every year your global peers are changing and people are coming in and out of the comparison set, your capital charges could be bouncing around just because somebody goes below a threshold or some new bank comes in. And there was this concern that for capital planning, you can't have your capital standards changing by tens of billions of dollars from year to year. And so the concern, I think, that got us to method 2 was that method 1 was just going to be very, very unstable. We're not going to really be able to tell how it goes. And if we try method 2 for a while and then update it, we ought to be able to get to a better place. Now, as Steve just pointed out, we haven't got there. So the first set of questions we were going to ask is just lightning round. You've already told us you'd favor going to method 1. I don't know if anybody else here wants to take on method 1 or say we should do something completely different, but that would be helpful. And to the extent that there is a difference of opinion, is it because you think the numbers are wrong or because you think the concepts are wrong? And then finally, former regulator here, I know that in the room that some of the Fed people will set that bottom bullet is going to be very important, which is how much capital are you willing to release if you go down this technical calculation. Maybe we don't have to worry about it because if we do the whole thing in totality and holistically, we're comfortable. But I think we should have an open discussion about that. So why don't we just go quickly? Why don't you start, Steve, since I think. Right.
So I already let my views be known that I'm certainly an advocate for method 1, but maybe there's just 2 quick fixes that I'd like to highlight. So let's call it a modified version of method 1. The first is simply addressing the issue of cliff risk. The simple fact is that the buckets are too wide, and this is something actually in the latest GSIB proposal they were looking to address by shortening or tightening up those increments. I think that's a very sensible change. And the other sensible change, which actually might increase capital requirements slightly for the banks, but I think is quite prudent and sensible, is eliminate the year-end window dressing. So there should be some averaging effect which better captures how you're managing the balance sheet day to day throughout the entire year, not simply what's happening on December 31st, especially since there's always something that's unanticipated that ultimately it could pose a greater risk and drive significant volatility in balance sheets and capital minimums.
I'm going to go for a modified chewback here. If I was king or an unbridled vice chair, I would move probably to something like the UK system. They use method 1, and they also have a 1% CCYB. Now, some of you simplicity addicts in the room might say, geez, isn't that more complicated? Well, method 1 is pretty simple, transparent, it's been pretty stable, so that one is not super complicated. I know there are some weeds underneath it, but it hasn't moved around that much. But then why would you add a CCYB component? Well, we call this a GSIB buffer, but I think some of these requirements don't have a lot of buffer-like attributes. There was a Bank of England speech a while ago by Andy Haldane where he called some of these buffers concrete airbags. Those are not the most kind of fun protection devices in your vehicle. So I think if I was going to do this partly from the standpoint of overall capitalization, because if you go all the way from method 2 to method 1, that's a pretty big jump. And secondly, from giving the flexibility to people at the Fed for a COVID shock, something that's broad where you'd say, this is a time when I actually want to put some air into the system, I think having a starting point of a 1% CCYB kind of accomplishes both of those. And I don't think it's actually that complicated. Okay, Al?
Sure. So as a 2.5% method 1, who you never know how the last week of the year's FX rate's going to move, that 2.5 could quickly become 3.5%, and you don't find out until it's too late. So I would say that a lot of the work that has gone into method 2 here in the U.S. is, I think it makes, again, from a practitioner's perspective, a lot easier to manage, a lot more predictable, and there's enormous value. I think in most of these places whether it's the concrete airbags, but in general, I think you kind of want the banks and service providers and intermediaries operating in a sort of a degree of with a high degree of confidence, and that promotes continuity and availability of credit. I think that that said, if my message wasn't clear enough earlier, I do think that method 2 is just drifted too high, and so that should get scaled back. But so yes.
Yeah, I would agree with Al. I think the easy place to go is dealing with the drift in method 2. Again, that's very consistent with what the statute contemplated, that changes in the GSIB surcharge or heightened capital requirements would be based on risk, and that they wouldn't go up simply over time arbitrarily, and that's effectively what's happening. I also agree that reducing the buckets, again, more consistent with the statute, and makes for a gradual application and gets rid of some of the cliff effects.
Yeah, I would also just flag that the Basel Committee had put forward a proposal to deal with the averaging, but the averaging only, whereas, and to address the window dressing concerns, whereas here the NPR from 2 years ago had, tried to tackle the averaging and bucket sizes. So that's something that's certainly important. I think, at least for JP Morgan Chase, we've been on the record for 5 years in a very, very public way that, we should do the smaller bucket sizes, that adjusting for growth, of course, undoing the gold plating, but in the grand scheme of things, a lot of those mechanisms are actually net translate better to the end users and a more continuous and availability of credit.
There are a variety of questions put out in the notice about other things that could be done. I've put a few of them here, but let me just start by saying, imagine you could fix one or two other things in the framework. Is there something that jumps out at you? Some of the questions that came from the staff are, how important is it that you have a credible resolution plan? Should the board actually have to make an affirmative judgment that that's the case? If that's true, then that should substitute for some of this capital charge. Is there a way to, figure out the quality of resolution planning more generally? So those are clearly complements to each other, or substitutes, I guess. And then might there be some other interaction between what's going on with the GSIB surcharge and other objectives that are not just related to GSIB? So why don't we do another round, and then we're going to open up for questions, and I'm going to take questions in groups, and we'll see how many times we can get through. So go ahead, Stephen.
All right, I'm going to keep my comments tight because there are quite a few items I want to list here, but I already touched on window dressing. We already discussed cliff risk. With regards to some of the other fixes, I'd mentioned GSIB coefficients, short-term wholesale funding, establishing some sort of cap, and resetting back to that 20%. And then just the most technical, but I think critical element is revisiting this probability of default versus loss given default framework. The banks are just inherently much safer than they were 10 years ago. When we think about everything that's been introduced and proposed since, liquidity coverage, net stable funding, TLAC, stress testing, resolution planning, all of this provides a very effective system and checks and balances, and that shouldn't be overlooked. So in the context of what I think needs to be fixed, I think those are some areas that could be addressed. Whether we adopt method 1, some modified version of method 1, or a modified version of method 2, I think there are some obvious places that we can apply those fixes and drive some meaningful and immediate enhancements.
I'd probably make a couple of technical comments. One, I do think having a credible resolution plan and having big chunks of TLAC is important. It's a big second sleeve of capital that protects the operations of the system from the kind of collapse we saw in Lehman Brothers. So I think having that 1.1 trillion underneath you is important, and I think that should make us feel more confident that we don't need to kind of keep riding the method 2 surcharges that have been drifting up. Second point, I do think that would also be helpful in terms of this too middle to fail challenge that I talked about before. I do think there are some banks that would be really awkward to handle if, God forbid, they ran into trouble. And I think that's an important thing that we need to think about. Where do we start this system? Lastly, a brief rant. Method 2 has a short-term wholesale funding thing that is a ratio. So you wouldn't want to index that for nominal GDP growth, but it has some flaws in it. You're dividing short-term wholesale funding by RWA. So as you reduce your risk, that ratio can start to grow and grow and grow, and you get some really weird effects. Because I have weird hobbies, I was looking through some of the Method 2 scores over the U.S. landscape before today, and there were some periods where $100 billion IHC was considered the riskiest bank in America. by that score because they didn't have enough RWA to dilute that denominator and it was uncapped, and so you got these really weird effects. So I do think that is, the wholesale funding thing is an important challenge, but I think that number as it's worked out is a bad collusion. We need to fix it.
Yep, a little bit repetitive, but I think from a structural fix, smaller buckets, averaging, all good, adjust for growth, undo the gold plating, adjustments to the short-term wholesale funding, which seems to be a lot bigger than intended. And, just to delve, we are on the GSIB panel, so nerd out a little bit, but inside the framework is something known as the reference bank. And so, if the largest banks grew, the sort of so-called reference bank, which is the sort of comparative that's done and says, well, the largest banks have to hold capital relative to this reference bank, that reference bank grew too. So I think it's sort of, always important to keep in mind, like, what are we actually comparing ourselves to in this reference bank?
I'll add two additional areas of consideration that are broader than just the GSIB, and it kind of applies to all the heightened prudential requirements. One is that we need to be more sensitive to the other activities of the GSIBs, as Congress clearly specified in the language, and because of the systemic impact that overdoing some of these enhanced prudential requirements can have. And I think two I'd focus on are custody and market making. During the last, in the 2020 COVID shock, we saw a real problem with liquidity in the markets, and that still hasn't been fully adjusted. And the GSIB surcharge, along with all these other recalibrations, are important for helping improve that. Two is also, remember, custody banks people run to during crises. And I'm very concerned that you've seen some activities when we have stresses where custody banks aren't able to take all of the cash that comes to them, and that there's a real problem there. Those should be, those are the types of activities that we want to encourage towards our custody banks. They're very much a shock absorber in a crisis, and improperly calibrated GSIB surcharge can undo that nice safety valve. I'd also, just as a second broader point, which is follows up on the earlier panel about treasuries, is given the size of the U.S. Budget deficit and debt GDP ratios, more treasuries are coming. So it's not a question of if they're going to be ending up on bank balance sheets and other financial institution balance sheets. It's going to happen, and I think it's best to start thinking about how, rather than a lot of countries deal with large issuances of government debt through financial repression. I think we should start thinking about taking the opposite approach, which is, to the extent institutions want to hold additional treasuries, we should make it easier so that there's not a disincentive for them for doing so. That will help our overall financial system. The interest rate risk, I think, is a fair thing to monitor, but that interest rate risk, though, is going to be in the marketplace regardless. Again, these treasuries are coming, and I do have a little more confidence that interest rate risk could be potentially better managed if it within the banking system.
Okay, so thank you guys for being relevant, but also on time. And so we're going to now collect some questions. So raise your hand. I see one in the back. Remember to introduce yourself.
Hi, I'm Mark Miguel, economist at the Federal Reserve. I have a question for the panel. If we are to keep the Meta 2 and we want to make it updated more dynamically, what would it make more sense to you? To update it based on the size of the global financial system, like based on the global denominators, or based on the size of the US economy?
Okay, we'll collect a couple more. There was one in the middle here.
Thank you. Noah Cutler from Barclays. I'm wondering if you've given any thought, or you think we should give more thought to the GSIB methodology's cousin. This is the risk-based indicators and the tailoring framework, which affect the Cat 3 and 4 banks. So as you know, like today they share cross-jurisdictional activity and weighted short-term wholesale funding. And if you went to method 1, they would only share one of these risk indicators. And so just thinking about how to make a framework that's simpler, potentially more coherent, like, do you think we should, give that a little more thought, like how those tailoring categories are working for the Cat 3 and 4 banks. Thank you.
Okay, we'll take one more. Over here.
Hi, Bill Demchak, again from PNC. Just something to keep in the back of your mind as you go through the work set to do this. In 23, with the rise in interest rates and the failure of the 3 banks, one of the largest GSIBs in the U.S. came close. Wasn't publicized, but its marked capital ratio went below 3%. And you can argue the GSIB ratios, number is too high, but we had a giant bank come close. Personally, I think the fix to that goes back to EVE and some measure of actual balance sheet risk as opposed to how much capital you hold. But my point is, if you're not going to measure the risk correctly inside of a balance sheet, trying to make up a capital number is irrelevant.
Okay. All right, so we've got one question on very specific GDP or global bank size for the updating, another on tailoring, and then were we all being too rosy because we had a near miss that we don't like to talk about amongst the GSIBs. So who wants to go first?
I want the near miss.
Okay, I'll jump in first. To the first question, I'd go for the size of nominal GDP. We've had periods, I lived through the 2000s when there's a lot of financialization growing through the economy, and if you had it indexed to the size of all the other banks, but all the other banks are growing like Topsy, you don't bring any extra capital in the system during that period, and the financial system can grow relative to the real economy, relative to the government. So I think it's a little bit better to tie it down to the real economy, to the thing that ultimately we all work for, as opposed to a race where you could get some strange periods of financialization that might have an effect. I'm going to dodge the RBI indicators question because I don't know anything about it. I think Bill's comment about balance sheet risk is an important one. I remember talking to some of my European friends who were making fun of us for not controlling interest rate risk in the banking book better in the United States. I hate being made fun of by those guys. It's not fun. But unfortunately, in this case, they had a point, and I think that was something that, the interest rate risk in the banking book did bring down Silicon Valley Bank. They had no equity if you mark things to market. Pretty much same thing with First Republic. And there needs, although it's a complicated question to Randy's comments, I think those guys are way over their skis. So I think there's ways you can do it in a moderate way that prevents you from skiing straight into a tree, but having a little bit of a guardrail against some of that stuff.
I'm also going to punt on the second question, if that's all right. But the first question, I do think it makes sense to link it to nominal GDP. Bill, a lot of what you said really resonates. I spent many a weekend analyzing all the bank stocks, certainly during that banking crisis in 2023. Now, the one thing I would note is I do think that more banks, and this is just my personal view, should be subject to AFS mark-to-market. And someone was talking about the dangers of moving too much into held to maturity. I think it's also sensible to maybe contemplate a cap as to how much you can put in HTM. It could still be the majority of your securities, but it shouldn't be 90, 95%, because by the time you run out of liquidity and then you need to sell HTM securities, they're already going to be deeply underwater and you're going to have a negative TCE ratio. So you want to put parameters in place to ensure that you can avoid that type of situation. So those are two fixes that I've certainly thought about, but this is my one unique opportunity to actually opine on policy versus assess the impact on bank returns. So I figure I'd take advantage of that.
Sure. I think as far as the initial question, I would say maybe 10 years later, it's a one-off, but in resize the denominators, reset the reference bank, but then on a maintenance basis, sort of do something that's GDP based. So that might warrant it. So maybe we can have the reprise of the 10-year anniversary of the paper for part two. On the risk-based indicators, certainly sympathy. I think, again, it goes back to is that the right outcome? Where do you want to be? How do these things? I mean, I'm not the expert of shouldn't be, but I mean, certainly warrants a look. On the last point that Bill raised, I think it's actually I'll do my best to take that a bit head on. I think for me, one of the lessons that came out of 23, and I think this part of the rhetoric that hasn't quite made it out, to the public domain. I think one of the critical things is that whether you've got unrealized losses sitting in HTM, unrealized losses in AFS, that depending on whether or not you've got the AOCI filter in or out, at the end of the day, the most important thing is really just trying to keep track about when are these banks investable, when are they no longer investable, and when the bank is no longer investable, it's toast. It's over, right? We saw SVB try to do a capital raise. That failed. It went under. First Republic, a number of large banks, gave them, we put a deposit in, bought them some more time. They looked for an open bank solution. That was just not going to work. They went into receivership. As far as, and I think obviously there was a lot of people, certainly in the Twitter sphere, who became suddenly Monday morning quarterbacks and experts in sort of bank accounting and bank regs and AFS and HTM. I think really the key thing is that in the bank's contingency planning, in the sort of resolution planning, the critical thing is knowing, when to stop for gas, right? You drive on the highway, if you don't trust that your reserve thing is right, and my wife fills up at a half a tank and I fill up with 10 miles to go. So the thing is that, oh, sorry, it is on camera. Anyway, no, but I think, but in all seriousness, the thing that's really important is that the goal is not to have zero failures. I think the lessons from a Lehman failure was a spectacular failure, and that's the kind of lessons, okay, we don't want that again. What we do want is to have orderly failures, and that's what the whole system has been devised at. That's the kind of message we need to promote to the public and understand that, orderly failures are part of the system and part of the system working. In order to have those orderly failures, though, you just need to catch the falling sword at the right moment, and that, and that's really, I think that it is important that the bank that you mentioned, it was still positive, and and when they're still positive, there's ability to do that. And I think that, really the challenge when we think about the mark on an HTM, if the intent and the ability of the bank to continue to hold those securities in HTM, it's really a bet on the franchise and the durability. But that said, it really comes down to contingency planning and the connectivity to Title I and Title II for that matter, and make sure that it's sort of caught in time. And all of these, again, all of these capital measures, whether they're real measures, shadow measures, because everybody can do them. You could do it with FAS 107 in loan accounting, and that we saw in 2023 as well. That's really needs to be all taken into account for, when to curtail activities and stop activities and to try to repair the balance sheets. But, to do that, it takes time.
I'll punt on question 2, just to be consistent. And then, global versus U.S., if you read the statute, Congress is always talking about the U.S. financial system. It wasn't concerned about the global. So there is a U.S. bias towards how the statute works. So that's probably where I'm inclined to look. But it's not
between GDP and the size of the financial system.
I don't think so. I mean, I think it comes down to, at the end of the day, I think a lot of this is backed out about where we want the numbers to end up, and that is, you want to have it as relevant as possible, but I don't have a strong view on that. On Bill's point, though, I think is really a good one in the sense of, I think all of these comments here, at least, I think should be taken in the context that 165 does require stronger heightened prudent capital requirements on the largest institutions. And you have the stress test on top of that to ensure that we have a much more resilient capital regime. And I think most of the reforms here actually will make the system more resilient and more risk-based, so that behavior by the largest institutions, particularly the GSIBs, reflects the larger system. But again, we've got to get that right balance. There's been such an increase in capital. You can now see these adverse impacts that do need to be addressed to make sure we do have a resilient system the next time, and there will be a next time there's a crisis.
Yeah, and I think just to underscore the point that, it is important to have just confidence in the sector, confidence in management, and I think that the system is designed to hit a few speed bumps and keep going. And I think that one of the, I would say, premature critiques that often came out during 23 was that the question about the immediate mark-to-market or liquidation value, and I think it's a very unhealthy system if the entire world is conditioned to just run the world on a mark-to-market basis, because that's not what we are. There's many banks and throughout this country, many banks with very strong, healthy franchises, and that has to count for something.
All right, I think we have time for a couple more questions if there's anything else that is on your mind. Wow, look at that. Okay, we'll pay a liquidating dividend. You get a 15-minute break instead of a 10-minute break. Thank you very much.